The CFO is thinking to himself, why did I sit there all those years, pay all those fees, and not unlock this value sooner? It was sitting there waiting for me, and I just didn't know it until this Pat Healy character showed up and started unlocking my value for me. I can tell you, we do that.
Welcome to the Block and Tackle Show, hosted by Carl Block. He'll be tackling some of the biggest issues in business today. Welcome to the show.
Today on the Block and Tackle Show, I'm joined by Patrick Healy, the CEO and founder of the Issuer Network, the go-to advisor for companies when the stakes of where they list become as big as how they trade. Over his long career, Patrick has helped companies like Facebook, Zillow, and 3M run competitive listing bake-offs, negotiate multi-million-dollar co-branding deals with stock exchanges, and unlock hidden value from the listings. We'll dig into what really matters when you go public, not just your choice of investment banker or your timing, why your listing choice matters more than ever, and how smart companies manage the deal behind the deal. Patrick, welcome to the Block and Tackle Show.
Nice to be here. Thank you very much.
I'm really excited to have you, Patrick. You've got an interesting business and you've got an interesting background. And just really briefly, well-funded kid all the way through college and getting your MBA, adjunct professor at Georgetown's McDonough School of Business for 8 years. You've guest lectured at William & Mary, and you went to DC to become, what else? A CFO. And I guess you had the hot hand because you had 3 companies acquired in 6 years. So in another life, Patrick would be your CFO if you wanted to do an acquisition. He discovered his niche business about advising companies about all the tricks to listings and opened up the Issuer Network in 1995. Look, it's really great to have you. You are one of one, as you probably often hear, and nobody really can replicate you. Patrick, tell us what your value add is. It seems very unusual, very unique, very clever, but what is it that you actually bring to the table for these companies that are about to go through a listing?
I bring a long history of successful deals and a unique knowledge. And that unique knowledge is something, no disrespect to CFOs. A typical CFO maybe does this once in a career, rare to do it twice. But CFOs typically are focused on listing fee, and that's not where the money is. That's not where the opportunity is. And what I do is I unlock value by working in a bake-off format with a team. And that's a lot more than they would have received had they just tried to do it by themselves.
Okay, so I think it's fair to say that the value you're actually giving is you're getting value to a company beyond the listing. You're getting opportunities, which I know you're going to talk about in a second, where it actually makes a difference on their balance sheet, both in terms of saving expenses and potentially revenue that all by themselves, any exchange isn't prepared to say, hey, we're taking this company public. We really want to help them save costs and generate revenue as well. That's not what they're thinking, but you are. Talk about the value and the co-branding and what's so amazing about it. And by the way, to me, it's so amazing. I can't believe you're one of one. It's really incredible. But tell us.
Well, thank you. The value proposition that we offer goes exactly to the 2 points you raised. One is, how do you move the revenue needle? And the other is, how do you minimize expenses? And those two combined have a significant P&L impact. Your income statement is much better as a result of the services we provide. Now, again, exchanges are not allowed to pay you for their listing, but I've had situations where exchanges have paid for the company's services in ways never anticipated. And I've had some fairly creative co-branding programs that raised visibility for the company's product in ways that were never anticipated. Those generate revenue. We move the revenue needle. We also create programs on the expense side, working very closely with the CMO. And that's one of the things that's unique about our process, is this is both a marketing and a financial decision. And we involve both the CMO and the CFO in arriving at what programs are most appropriate for that company. And it differs by industry and by company.
Okay. And so when it comes to really how these co-branding deals work, you're basically getting the CMO kind of a free ride that the CMO maybe never anticipated. And if a company allocates dollars to their marketing spend, and now they're getting marketing benefits basically just pursuant to the listing. That's the beauty of the expense safe. But give us an example of the kind of promotion that you have gotten some of your listed companies.
Yeah, I don't generally give a lot of examples in public forums like this. Just for you, Carl, I'll go the extra mile.
Thank you.
In the case of B2C company, tech company growing rapidly, about a decade ago, both exchanges were trying very hard to help the company market itself better.
Mm-hmm.
And I came to the conclusion that neither of them were doing a very good job. And the CFO said, look, Pat, I need you to just take this and run it as if it was your company. And what I did in that particular instance is I actually sold advertising to the exchange on the company's hundreds of millions of outbound emails. So in effect, I made it a service that generated revenue for the company that was totally unanticipated. That can happen. In another instance, fairly recently, a national company, and they have it's a software company that has clients all around the country using their product. In this particular instance, they wanted to go on the road with tailgate parties to meet with customers, city after city after city, event after event after event. And we managed to get some funding for that program that was like super creative. And I almost laugh when I think about it, that it just came out of the blue, and next thing you know, you got a multi-million-dollar commitment.
I mean, that's pretty impressive. And I mean, it's obviously very creative. Again, you don't necessarily talk publicly about a bunch of the companies that you worked with, although we already know some of them have been huge companies.
Yes.
But you'll take a holistic approach to marketing that they could use, and you'll negotiate with the exchanges to facilitate that. And then voila.
Yeah. And, look, I tell my clients, this is fun. If you're a CFO and somebody's sitting there saying, give me your listing and I can promote your product, that's just like their eyes light up, right? It's exciting. And the things you come away with are highly creative. And it's not about ringing a bell. Yes, ring the bell, do all that. But there's so much more beyond that is really never envisioned. So I look at Bell and those kinds of things as soft dollars. So they feel good. It's a party that everybody wants to be at. But I'm more interested in the creative hard dollar programs that people don't see.
That makes sense. And yes, for those of there may be people who are watching who don't know that by ringing the bell, you mean when the exchange opens in the morning, you have a ceremony where the CEO or CFO rings the bell to signify the exchange being open for trading. And I get it. It's a nice symbol. Everybody takes a picture, they frame it or whatever. But you're working for the hard dollars or hard value that the exchanges will give. And so really, though, at the start, it's you doing your bake-off where you're saying to the exchanges, okay, you want this listing. Let's talk about what value we can have here. And you just have the exchanges compete against each other, right?
Yeah. And the funny thing is, I developed really strong relationships with CMOs because, they really are the beneficiaries of the creative ideas. Because again, we have two objectives here: move the revenue needle, cut the cost. CFOs are really all about cutting costs. They're the guys that bring the hammer down. Marketing guys, they're the spenders, and they want to see revenue go up by virtue of their activities. Well, they tend to like what we do.
No, of course. And I think you've told me previously, but tell our viewers why the exchanges would be so willing to compete and come up with creative marketing opportunities for a company that they're going to list.
Bottom line is that it's in their financial best interest. Get the listing because that gives them the lion's share of the trading volume, which ultimately leads to trading fees via the data center. What's really interesting about that, though, is that there's a certain level of vanity there, right? I got Facebook, okay, or I got this one. Yeah, but What they really get, really get, is an annuity. So let's just say they put up 10, 20, $30 million for a very attractive, high profile IPO. That's a big number. It's what they would say to themselves, wait a minute, you're only getting $500,000 a year. You're spending 30 and you got a 60-year break even. Not true. That marketing program is going to be over in a couple of years. And for every year after that, you're collecting not just the revenues at the data center on the trading side, but you're collecting that annuity for 20, 30, 40, 50 years, as long as that company's public and they don't switch exchanges on you. It's a big deal for the exchanges from a revenue perspective.
That makes sense. Let me ask you this, since you raised a very interesting point, and you don't have to identify the company. Have you ever been brought in where somebody's listed on an exchange and they talk to you and they say, look, can you negotiate a better deal for us on another exchange?
Happens all the time. I do it all the time. Well, first of all, what you're talking about is called a switch. And there's a company that says, look, maybe I'm not happy with my trading. Maybe I'm not happy with my fee, or maybe I want to unlock value. And that gets to the scenario you're referencing. The company will say, look, I believe you. There's value in my listing. Can you help me unlock it? I do that every year. I'll do a couple of years. What's really interesting, though, is that when you do that, and then the incumbent exchange upon which you're listed upon wins the bake-off. And that does happen, where a company says, okay, well, thanks for the 20 million and I'll stay where I am. And, the CFO is thinking to himself, why did I sit there all those years, pay all those fees, and not unlock this value sooner? It was sitting there waiting for me. And I just didn't know it until this Healy character showed up and started unlocking my value for me. And I can tell you, we do that. We do that a lot.
That's great. I have to say, I could see how there's times the exchanges love you and there's times where they don't love you, but it's interesting.
Well, that's really a good point you raised, Carl. Let me take a moment to describe. The key here is fairness. I can't favor a new exchange. I treat them exactly the same. There's only one person here that I'm trying to please, and that's the issuer. The minute I get off the 50-yard line, I'm out of business because I'm biased in some way. It just doesn't work. The most important thing is to be fair, to be an honest broker, and never work against the interest of your client. Oh, by the way, that's why I don't advertise. I'm not going to go out there and spill the beans on what somebody got or show favoritism toward one exchange. Can't do it.
That makes sense. So another thing, of course, that the CFOs would wonder, it's a natural question. How do you get compensated for bringing in all this value?
That's something I always like to talk about. I run very small but powerful business.
Small but mighty.
Yeah. I structure the compensation in a way that, when I first go in, let's just say, Carl, you were a CFO and I started talking with you and they say, well, I can talk to his customers and everything else, but how do I really know I'm getting my money's worth here? And so we structure it this way. We get a small retainer on the front end, just pays the rent while we're working. And then at the end of the engagement, we target a certain bonus incentive compensation. It's a very, very small number, percentage of what we generate. And we multiply that against the hard dollars we create. You're going to get a bell with us or without us. Why should I be rewarded for you getting something that I didn't have a hand in improving? So we'll have a target percentage. It'll be applied against the hard dollar value that we generate. And then you can adjust that any way you want. If you think we didn't deserve it, pick a number. That's our incentive comp. It is totally discretionary. And I will tell you that the overwhelming majority of the time, I'll get on the phone at the end of the engagement, say, how'd we do? You killed it. Here's what we're willing to do. My response is, thank you very much. Whatever you come up with is good by me. So I don't know any advisor or consultant or banker or anyone else out there that utilizes that compensation structure.
It's unique.
That's a really big point, Carl. We offer a guarantee. If you're not happy, you owe us a zero.
That's pretty acceptable, obviously. And as you say, I don't know advisors, legal, financial, or otherwise, that do that. And that's great. I mean, it makes it a very easy sell for people to talk to you because it's pretty apparent you're safe and you're going to add value. And it's just a question of what the value ends up being. I think most people would love to have advisors like that. So that's really good. It's really good. So let's talk about a couple of other things that you watch and you have opinions on. When we talk about the overall state of the IPO market. I'm guessing clients don't often say to you, should I do it now or should I wait? Is that right?
Timing is dependent upon the bankers, who have a much, much better handle on that than we do, because they run the syndicate. They've got the buyers and sellers in their circle of information. We stick to our strength, which is competition for the listings. The timing of the IPO, leave it to the bankers.
Understood. Well, look, that makes sense. Despite that, since you're doing this all the time, what do you feel like the IPO market is going to be like? So I don't know if there's going to be a lot between now and the end of the year, but what do you think about 2026?
Okay, well, here's my take on 2025 and 2026. 2025 was humming along quite well until the tariff situation hit. And that sent a chill in the market that stalled several deals that we had and many, many more that were out there. You can't go into the pricing with an uncertain market. I mean, you're putting out probably 10, 15% of the value of the company in the first tranche here. If that gets haircut by 20%, guess what? You've got maybe, a couple $100 million that you should have received that you didn't. So, the bankers rightfully say, hold the phone. We're going to come back when things are a little bit more tranquil. And then just as we were getting there, right after Labor Day, things started happening. One of mine went to market, priced very well, excellent company, but here comes a shutdown. All of a sudden, you've got a second cold chill. And maybe this one is not as market concerning as the tariffs, but you can't get anything through the SEC.
Of course not.
Right? So they've got some temporary fixes and some other things, but it's not the same. Most of the lawyers are saying, let's wait for the window to open again. So that gets to the second part of your question, 26. I think there's a pent-up demand, and I think 26 is going to go gangbusters.
I'm sure there's a lot of people thinking about it. And your underlying point is a company can think, we've got a great business plan. We've got underwriters who are interested in us. People love our products, our technology, or what have you. But external events can cause uncertainty, which obviously the markets don't like and underwriters do not like. So I take your answer to be, assuming that there's no subsequent shutdown, major wars, pandemics, or major banking crisis, you think 26 should be a pretty good year?
Yeah, subject to market conditions, yes.
Carl Block is both a corporate lawyer and a corporate restructuring partner. Nothing in the podcast should be construed as legal advice.
If you want more info on the show, please visit blockandtackleshow.com. And you can also email me at carl@blockandtackleshow.com. Thanks for tuning in.